Okay, Chapter 9 deals with property, plant, and equipment and intangible assets. Basically, that's what it is. Most of the work in Chapter 9 is upfront in the first two objectives. So in the first objectives, we're going to be looking at property, plant, and equipment. So when you see, say, equipment on the balance sheet and there's a number next to that equipment, how do they get that number? Well, you're going to find out in Learning Objective 1. And then, as you probably remember from learning about it way back in the day, which was just last semester, you learned about a depreciation expense and accumulated depreciation. What you're learning here in this part of the chapter is the actual depreciation methods that are used to calculate that depreciation. There are three of them, but we're going to focus more on one because it's just so popular and for good reason. Okay. Then a little bit, learning objective 3 is basically after we have used, remember all plant assets have a useful life. They go through a period where we're going to use them for a period of time for the business, in which case we're going to need to replace that asset, right? I mean, if I had a pizzeria and I had a pizza oven, I mean, it's not going to last forever. So if I'll be using that pizza oven for quite some time, that's its useful life. But then after that, I'm going to have to replace it eventually. So what happens when a company disposes of fixed assets like equipment? How do they handle it? Then we're going to be looking at intangible assets, mostly focused on definitions and concepts here, and then a little bit of analysis. Not much, but just a little. So first things first, and this slide is correct, it's totally wrong. I don't know, quality controller Wiley's going down, I think. But basically this is, what are plant assets and how do they recognize them, right? So property, plant, and equipment is what plant assets are. You can call it property, plant, and equipment. You can call it plant and equipment. We used to call it fixed assets back in the day, but they simply mean the same, property, plant, and equipment. These are long-term assets. They have a physical substance, meaning, a building is a building. You can touch it. Equipment is equipment. You can touch it or use it, etc. That's a physical substance. But this equipment are used in the operations of the business, and it's not for sale to the customer. So a customer might come into my pizza shop and say, hey, how much will you want for your oven? And I'm like, it's not for sale. I need my ovens to bake my pizzas so I can sell them. So these are not available or not intended to sale for sale to customers. They are expected to help us generate revenue, right? They are expected to provide a service to the customer, to the company rather, for a life that is measured usually in a number of years. So this is property, plant, equipment. So these are long-term assets, which are will be held at least over a year. And it depends on the type of asset. It could be held on for 30, 40, 50 years. Okay. So plant assets are very, very important. Property, plant, and equipment are a very large part of some companies' total asset base. When you look at something like Wendy's, here, I don't know when this was actually done, 73% of its total assets are tied up in property, plant, and equipment. And that makes sense because they own all their buildings. They own all the furniture in those buildings. They have refrigerators and freezers. They have various cooking equipment, from grills to deep fryers. They have the equipment that makes their wonderful frosty ice cream. I don't want to make anybody hungry there, but so that's a lot. That's a lot of money to have. Plus, they own the tables and chairs, and the signage outside, and the drive-through equipment. All that other stuff is all part of that. So clearly, there are some companies that have a large percentage of their assets as fixed assets or property, plant, and equipment. Of course, airlines, it's the airplanes, right, mostly, um, that make up a lot. Some companies don't need as much. Some companies don't need as many property, plant, equipment. So when you look at a balance sheet and you see equipment listed at a price, well, how do they get that? Well, they have to use what's called a historical cost principle, which means when they buy it at a certain cost, and that's what they use to debit the equipment account, that particular cost, or any of the asset accounts. Again, there's land, there's buildings, there's equipment. It's at the cost. That's historical cost. Okay. Now, that cost is just not the cash price. It's all expenditures that you have to do to make it ready for use. That's the standard is ready for use. Okay. And so that's what you're going to learn about as well today. We will talk a little bit about these in the coming slides. But basically speaking, when we say buy a delivery truck, there's going to be certain types of things we need to do for that truck. There's regular maintenance. And so those will be matched with revenues as general expenses. So they'll be on the income statement as general expenses. However, there are some times when we do something to our equipment that might actually change the equipment for the better. It might actually last a lot longer than we planned. And so you're going to learn about something called a capital expenditure, which we will add to the cost of the asset. So you're going to see that in the future. All right, so again, the whole idea is cost here. We basically use historical cost as the measure. However, as you will see in the coming slides, sometimes it's not a good idea to use the cost on the balance sheet. You saw that with the inventory. And so they went through a process of the lower of cost or market standard to see what they should value that. Sometimes we have to do that with property, plant, and equipment accounts as well. We have to list it at fair value. However, cost is basically the first measure. So let's look at, I think there's 4 specific accounts. These are asset accounts. Land is an asset account, and it's the first one that's listed in that category, property, plant, and equipment. Property is land, old term for it. So when a company goes ahead and buys land, what do they put in the land account? Well, it's not just the cash price for the land. It's all the costs necessary to make the land ready to use. So certainly they have to pay the cash price. Now, land is real property, so you have to show ownership that's registered on the Registry of Deeds in your local government that you are the owner. That means you have to have a title that has to be available to take. And so that's usually there's title fees, there's attorney fees to make sure all that is registered properly. If you're buying land, you're probably buying it from somebody, and that someone is usually represented by a broker. And so there's brokerage commissions to pay. You might also be represented by a broker. Anyway, there's brokerage commissions. And so that's also part of the costs of the land. If you're not paying those, you can't get title for the land. And then if sometimes you can't get ownership of a land unless you clear up some back taxes or other liens, which are legal obligations against that property that you might need to pay in order to take title of the land. There could also be junk on the land. And of course, you just can't leave the junk on the land. You're going to have to clear all that stuff out as well. That's not listed here, but it certainly would be a cost that you would need to do before you're ready to use the land. There's a For example, in Hyde Park on Route 9, across from the CIA, they're putting up a spa, right, a hotel and spa, on a basically piece of land that had a couple of old things on it. They had to take all those things down, and they had to basically level the land. And then now they can start building stuff. So that literally is everything they had to do to get the land ready to use. And so all of that expenditure would be part of the land account. Land is an asset, so it would show up there. So here's an illustration. Speaking of which, purchasing land, we have a manufacturing company that bought land for $100,000. There was an old warehouse on it that they raised. Okay, so to raise it is simply to knock it down, take it out. It cost them $6,000 to do that. They had to pay attorney's fees. They had to pay a broker's commission. What's the cost of the land? All of it. Okay, the cost of the land is all of it, because all of it had to be done in order to get the land ready to use. And so this becomes the cost of the land that's going to be debited to the land account. That's going to show up on your balance sheet as the real value of the land. All right, hey, you're going to be learning, this is a brand new account. I don't think you've seen this one before. This is an asset account called land improvements. So land is just land. Land improvements would be things like putting a parking lot or driveways or fences or things around the land. Okay, that would be a land improvement. And so money that's spent on land improvements are going to be, so if you build a parking lot, if you put a fence around it, that's all going to be debited to this asset account, land improvement. Now, the difference with land and accounts like land improvement is that land is going to last forever. Okay, the planet's been around for, and whether you're a strict religious person or you're more scientific, so anywhere from say 6 or 8,000 years ago to 800 billion years ago. So the place is old. We're on an old planet. And so the land has been here. Land is always going to be useful. However, when you build a parking lot, it's not going to last forever. Okay. So the first thing we need to figure out when we do these types of things, and you'll see this coming up for the other property, plant, and equipment accounts, is we have to think, how long is this going to be useful to our business? Now, I have a friend who owns the Bank of America building in Canaan with a parking lot. And he has to have that parking lot done over again, roughly every 10 years. And so basically that would mean that when the parking lot is done, that business that he runs says, okay, this is going to be we expect to use this for 10 years. That's the useful life, after which it would need to be replaced. Okay. Same thing with fences, same thing with all these things. They're only going to last a certain amount of time, at which point they need to be replaced. They're no longer useful for the business. Okay. Because nobody wants to drive, particularly in a place like New Canaan, which has an extremely high income. They don't want to drive their cars, their very nice cars, on some old shitty pavement. Okay, they expect more. And so your parking lot's only going to last so long before you need to get it done. So if it has a useful life, that means, well, you can actually start allocating some of the cost of that to something called depreciation expense. And so this depreciation really is a way of allocating the cost of these types of assets slowly over time. You get to expense some of the cost or all of the cost of these assets through depreciation. And so that's how depreciation sort of comes into being. You'll see how that works in Objective 2. Buildings are another account. It's an asset account. It's property, plant, and equipment. Property, plant, and equipment is a plant. The word plant is an older word for factories and buildings, things like that. So, so buildings would go after land on a balance sheet, normally speaking. For buildings, you really got two choices. You either buy an existing building, or in the case, like I mentioned in Hyde Park, there's just a piece of land there, so you actually have to build a building, you have to construct it. So in the case that you actually are building, you're buying something that already exists, then your building account would need to include not just the purchase price of the building, but again, it's property, so it's got to be registered as an owner on the books of the government locally, right? So that's going to be title insurance, title fees, attorney's fees, etc. And you're probably going to pay a broker's commission. So that's all part of it. But a lot of buildings are older, and codes, health codes, building codes, safety codes, fire codes, all types of codes basically get updated over time. And so you might need to remodel the building to get it up to code. You might also need to repair or replace some very important parts of the building, like the roof, like the floors. Again, you might need to get the electrical or plumbing system up to standard before you can open. So again, all of that is required to get the building ready to use, and so it's all part of the cost of the building, and that's how it would be shown. Okay. Now it's different when you're buying a building and land, a building that's already has land as part of it. Then when you're actually buying that, you actually have to separate it into those two accounts. A portion of the price that you're purchasing is going to be in the land account, and the other portion is going to be in the buildings account. And there's ways to do that I'm not going to do with you here, but as you continue, you'll learn. Again, if you're looking at just a plain old piece of land and you need to build a building, you're going to need to get an architectural firm to actually design all that. There's lots and lots of permits that you're going to need to make sure you get. Those are costly. Your building has to be, the land and has to be excavated. If it's in a very big city like New York, that has to be, it has to be put into the bedrock, so it's not going to collapse. Particularly if it's a high-rise building. So, there's a lot to do here. Plus, of course, all the costs of building the damn thing, right? Which is the contract price. So that's all going to be part of your building account. Everything you need to pay to get it ready for use. Property, plant, and equipment. Well, this one is equipment, and it matches exactly in the property, plant, and equipment. Same name. Equipment can, of course, be a catch-all for almost anything. So whether it's computer equipment or office furniture or very large, like a pizzeria, I could have my my refrigerators and cash registers, everything all in the equipment account. Even if I had a vehicle, but in a small business, it's usually just thrown into one or two smaller accounts. As you get it bigger and bigger, and you're going to have very specific accounts for that. But in general, you can throw it all in equipment; it would look the same. So, what's in the equipment account? Well, the cash price of buying the equipment. Since you're buying a product, the sales taxes in most states are structured on products, manufactured goods. And so you'll probably be paying a sales tax on that as well. You're not buying this from your neighbor, so there's going to be freight charges involved. And we're talking, what if it's HVAC equipment? What if it's a big molding machine? What if it's a robotics, part of an assembly line that's robotic? There's going to be freight charges. You're going to need insurance on that to make sure it gets to you safe and sound. And then you got to assemble it. You got to install it. You got to test it. In some cases, if it's very new, you might need to train people how to use it. In some cases, if you need like a special foundation to put something on, that foundation is part of the assembly and installation. So that's going to be part of it. So there's a lot to this idea of the cost of equipment. put it that way. But again, it's got to be ready for use. Once it's ready for use, that's where it stops. So here's an example of a company who bought a delivery truck for $22,000. Must be a really small truck. They paid sales taxes of 1320. They painted and lettered that thing for $500. They got a motor vehicle license for $80, and they got insurance. So what's the actual cost of the truck? Well, first of all, you have to pay the cash price of the truck, $22,000. You have to pay sales taxes on that. So that's part of the truck. And then, if you are a business like, UPS or even Optimum, they're going to want to have that painted and lettered before it goes into service. So all those would be part of the cost of the truck. A motor vehicle license is not to get the truck ready. It's to get the driver ready. And so it's not part of the cost of the truck. It's going to be expensed by the business because they're paying for the motor vehicle license for their employee to drive it. And every time you buy insurance, you know how this works. It's prepaid insurance. Every time you buy insurance, it's prepaid insurance. Doesn't matter what it's for, truck, building, fire, liability, it's prepaid insurance. So the actual truck account would be debited by $23,820. That's the real cost of the truck on the books of the company. Okay. So basically, even though they spent $25,500 on all of this, as you see here, the equipment account or the truck account, vehicle account, whatever they have, is going to get debited for the $23,820. The license, like I said, is simply an expense. The license doesn't get the truck ready. The license gets the driver ready. Okay. And prepaid insurance, every time we buy insurance, that's what it is. So think about a truck. You need, in order for that truck to have a useful life, let's say UPS buys a delivery truck and they're thinking it's going to last them 4 years because they drive those things pretty hard 7 days a week. They'll actually be lucky to get 4 years out of it. Well, that's going to be its useful life. In order for that truck to last 4 years, it needs to be maintained regularly so it can last the amount of time they expect it to last. So simple maintenance on a truck or any equipment simply is expensed as maintenance and repairs expense. Okay. However, if we in one way, shape, or form change the useful life, change the useful life of the asset, make it, say, instead of that truck lasting 4 years, a couple of years in, we had to overhaul the engine of that truck. So, well, we were thinking of keeping it 4 years, but after the second year, we overhaul the engine. Actually, we can keep it for 4 more. So now the life has gone from 4 to 6. It's expanded 2 more years. So that's actually going to be debited directly into the equipment account or the vehicles account, because now you have improved the asset to last longer. Its useful life has increased. The maintenance is just to keep it for the useful life you're expecting it to live, be useful to you. Addition and improvement increases that life to the business. Okay, you've been subject to lots of frauds. I'm not going to go over this. I will talk a little bit about a lease here real quickly. You understand that a lease is basically you're renting, right? So it's a very large contractual agreement. So what happens when, let's say I'll go back to UPS, not that I'm favoring anybody, but they decide they're going to lease a fleet of vehicles. Well, what does it look like? Well, a lease is both an asset and a liability. They're going to use those trucks for a few years. That's part of the lease. But they owe money on those trucks, like a rent payment. And that lease is basically a contract to liability. So basically, leased stuff is not reported on the financial statements. You'll never see it on a balance sheet. What you will see it is on the notes to financial statements in the annual report. They will explain how much of their how much equipment they have leased, and how when those leases will end. Okay, so that's important to know, and that's really all I want to go over with you on that. All right, so we're already to the second learning objective here, in which we talk about how to do depreciation. There are three major methods. Actually, there's more than three. There's more than that, but three is what's covered in this book. Um, and so again, depreciation is really about the fact that we are going to buy um, a plant asset, and we're going to use it in the business for a period of time. We call that a useful life. Okay. Um, so that pizza oven that I buy from my pizzeria, it should I should get 10 years out of that pizza oven before it basically, isn't really worth that much. It might break down a lot, might be repaired. I can't afford to not have a pizza oven. So I'm going to say, okay, after its useful life, I'm going to replace it. Okay. Same thing with UPS and their trucks. After that period of time, they're basically going to replace it. They're not going to repair these things over and over again for what? It'll hurt them. It'll hurt their revenue because they pride themselves on delivery of those things. And so why hurt that by keeping a truck another year? So you're going to, when you buy it, you're going to have a useful life. Depreciation basically says, look, you are going to use this asset for a long time. And so we're going to create a process where you can allocate part of the cost of that equipment or that plant um, to an expense. Okay. And why can it be expense? It's because that the property plant and equipment account is being used to help produce revenue for the company. My pizzeria, the building is where people come in, order their pizzas, sit down, have their pizzas and stuff. I need all that stuff to sell pizza. Even if I didn't have my refrigerators or my ovens or my tables where I prepare stuff, I wouldn't be able to sell pizza. So clearly they're directly related to me generating revenue. All of it is. Okay. Even my sign out in the front saying that I'm a pizza store indicates that if people didn't know I was there, I wouldn't be able to sell my pizza. So all of these property, plant, and equipment accounts, with the exception of land, are helping me produce revenue. And because they're helping me produce revenue, I can expense a portion of that. That's that process, depreciation. Okay. So how do we do it? Well, you already learned in objective 1 how they come up with the cost of the asset. The whole learning objective 1 was about this cost thing. Now you know that. You also heard in objective 1 about a useful life, right? That means when the company is buying a asset, they already have in mind when they buy it how long they intend to use it in the business before it needs to be replaced. Okay, useful life. Well, for some assets, even after their useful life is done for the business, some might have what's called a salvage value. Some books call it residual value. But a salvage value is basically the remaining value in the asset once we're done using it. Now, this is going to be different depending on the asset we're talking about. So, for example, if I had a computer system, no one's going to want, it's not going to have a salvage value. After I use this for, say, 3, 4, 5 years of my business, it really has no value, right? I'm going to use up all the value in it. And so, there's not much of a market out there. No one's looking for a 5-year-old computer. Okay. So the salvage value in some cases will be 0. However, you all know, because you've seen them, there are a lot of older police cars that have been decommissioned and they're sold, and some, maybe some of your older neighbors might be driving them, and even some with the light on the side. I think those are really kind of cool. But nonetheless, so even when you have a asset like a vehicle that's going to be driven into the ground, because those cars are on almost 24/7, even after the police departments are done using that, well, they sort of have a value. They have a small asset value at the end of its life, clearly. And so that becomes an estimate that's also made at the time you buy the asset. So right away, look at all the things you got to decide when you buy the asset. Okay, so what's the total cost of that asset? Okay, how many years am I going to be using this asset? Okay, and then once I'm done using it after those years, is it really going to be worth anything? Okay, that's the salvage value. So you have to understand that these factors are important. So once you decide that, you are going to also decide what depreciation method to use. So you can start allocating the cost of the asset over that period of time, over its useful life. Well, as you see here, the clear winner, okay, the clear winner is straight line depreciation. There's a couple of reasons why it's the clear winner. One, it's easy to do. Two, it also aligns with tax records, so they can use straight line depreciation when they do their tax forms. So there's really a couple of really strong reasons to use straight line depreciation. However, as you see, there's a couple of other methods here. One of them is called the declining balance method, which is simply kind of an accelerated method. And the third one is simply something called a units of activity method. And so instead of what a unit of activity method is different is straight line method uses the number of years that we're going to be using it as a useful life. Units of activity uses a unit. So instead of saying I'm going to own this truck for 4 years, the unit, which is common in the first two methods, the unit of activity method would say, I'm going to use this for 200,000 miles. And the mile becomes the unit. So the more miles you drive that truck in a particular year, the more it's going to depreciate. The less you drive the truck in a particular year, the less it's going to depreciate. That's basically what a unit of activity method is. But they can use it for, copies on a copy machine, tire companies that make those molds for tires. Those, the molds could be a unit. Some businesses will use it, some won't. As you see here, it's 5% of businesses use it. So it's really, really small. So the clear winner, straight line, that's where most of your effort's going to be here. Okay. All right, so let's take a look at an illustration of how these work. So Bill's Pizza, my competitor, purchased a small delivery truck. How small? $13,000. I don't know. What is this? Does it wind up in the back? Is there like a little, string you pull to get it going? I don't know. I have no idea. But that's really a very inexpensive truck. So it cost Bill, either way, I'm done with my commentary, sorry. It cost Bill $13,000 for this truck. So Bill has a couple of questions to ask once he's determined the cost, right? How long is they going to use the truck? So in years, 5 years. That's its useful life. In units, 100,000 miles. Once they're done after these 5 years, will it have any value left? Bill thinks, yeah, about $1,000 value. Okay. So these become really important to sort of understand. Those are the questions that go back to the other illustration. Right? and they sort of make sense. So here it says to compute the depreciation with our very favorite method, straight line, that you're going to learn about. B, units of activity. And C, declining balance. So let's get started, shall we? First thing we have to do is understand that for straight line method, we have to do two things. First is we have to figure out how much of the vehicle is actually subject to depreciation. And the amount of the vehicle that's subject to depreciation is the difference between what we paid for it. So we paid $13,000 for the vehicle, minus how much the salvage value is going to be when we're done using it. The difference is what can be depreciated over time. That's called depreciable cost. This $12,000 is going to be divided into the 5-year period, because that's how long in years we're going to use it. So literally, Bill's Pizza is going to have a depreciation expense on this truck every year, $2,400 every year. Okay. So the expense in a straight line is the same amount for every single year. You just have to figure out what is the depreciable cost. Like I said, the difference between the cost and the salvage value you depreciate, and how many years you're dividing it into. That's your annual. So here's an illustration. This is also in your book as well. So first thing is we bought this truck in 2017. And we bought it in January, so we have a whole year use of the truck. Okay. We know from that calculation that we are going to depreciate $12,000 of that truck. Right. That's the difference between the $13,000 we paid for the truck minus the $1,000 in salvage value on that truck. The difference is $12,000. And we're going to do it for 5 years. Well, if we're doing it for 5 years, that's the same as breaking it up into 20% each year for 5 years. That'll be 100% of the depreciation. It's sort of broken into 5 years, 20% per year. Okay. So if you had $1 and you broke it into 5 pieces, 20 cents for each year, 5 pieces, right? So that's all they're doing here. So the annual expense in 2017, at the end of 2017, they would make a journal entry. Depreciation expense would get a debit of $2,400. That shows here. Accumulated depreciation for equipment, $2,400 credit. That would show here. You understand that the expense, depreciation expense, expense accounts get closed at the end of the year. But we know how much we expense because it's going to stay in the accumulated depreciation account. This is a contra asset account, so it's always going to be open. The book value of this truck is the difference between the cost of the truck and the accumulated depreciation on that truck. That is the book value. So what was the cost of the truck? $13,000. How much do we have in accumulated depreciation? Well, after the first year, $2,400. So 13,000 minus 2,400 is a book value of $10,600. So after the very first year, our truck will have a book value of $10,600. In the second year, we are going to allocate another 20%, so another $2,400. This is an annual expense, right? Another debit. So this is going to be the journal entry for every year. Now we're in 2018, right? Still the same journal entry. Debit to depreciation expense, credit to accumulated depreciation. Your expense account, of course, at the end of the year will close, but look what happens. Accumulated depreciation does not close. It shows $4,800 of accumulated depreciation, which means it's the expense, depreciation expense, these 2 years added up, right? That's how it's going to balance at $4,800. So the book value at the end of the second year is the cost, that $13,000 truck, minus how much is in accumulated depreciation? Well, $4,800, which means the book value is $8,200. Okay. The difference between 13,000 and 4,800. In the third year, same thing, right? We're going to have the exact same journal entry. I'm going to make this a real mess here, but 2019, the end of 2019, depreciation expense, $2,400 debit, accumulated depreciation, $2,400 credit. At the end of the third year, of course, we close the book, so this expense will eventually zero out. However, accumulated depreciation does not. And now accumulated depreciation shows 3 years of depreciation expense accumulated for that truck. So you have a $13,000 truck. You now have, after 3 years, $7,200 of accumulated depreciation. The book value of that truck is now $5,800, getting lower and lower. In the fourth year, it's the same, right? So again, I'm going to make a huge journal entry, 2020 here. Woohoo! Okay. Depreciation expense gets a debit. Accumulated depreciation gets a credit. You know what happens? We close the books. So this $2,400 expense of depreciation will eventually be closed to zero. However, look at accumulated depreciation. It is now showing 4 years of depreciation. 24, 24, 24, 24. There's your $9,600. All these 4 years accumulated. What's the book value? $13,000 that we paid for the truck minus the $9,600 that's in accumulated depreciation. Now we have $3,400 book value of the truck. Very last year, we're going to write off the last $2,400. So this is 2021. Sorry, it's really messy. Debit to depreciation expense, credit to accumulated depreciation. You understand at the end of that year, that will close. However, you'll see that now 5 years of depreciation expense has accumulated to the $12,000. That's exactly what we said we would have as depreciable cost. Look at our book value of the truck. The book value of the truck is exactly what we said the salvage value would be after we're done using it. We've used it for 5 years. We've accumulated $12,000 of depreciation, which we said we would. We have $1,000 book value or salvage value, which we also said we would. Okay. That's how it works. You have to know how to do it, and you have to know how to read these. Fascinating. Tell me more. Sure. Well, what if you didn't buy it in January? What if you bought that truck in April? Well, if you bought it in April, you only used it 9 months the first year. The annual expense is $2,400, but that's for an annual. That's for all 12 months. In the very first year, you've only owned it 9 months. So what are you going to do? Well, you take the annual expense of $2,400 and multiply it by the 9 months over 12. So in your very first year, you can write off $1,800, right? In 2017, if you bought it in April, you only owned it for 9 months in 2017. So even though it has a straight line depreciation of $2,400 per year, the first year you only owned it 9 months. So you can only write off 9/12 of that. Okay. So this would be, at the end of 2017, you'd have a depreciation expense of $1,800, and that would be accumulated depreciation balance of $1,800 as well. Then for the full years, you wouldn't have any issue. It look the same, right? The full $2,400 expense to every year. What happens is you only wrote off 9 months here, and you have 4 years. So you have 4 years and 9 months. You got to write off the last 3 months, which is what you do in the last year. So the last 3 months of this, right, is going to be written off. The 600 and the 1,800 is the 2,400. But now you have to split that into the first year's 9 months, and you roll over the last 3 months into the following year. But you're still depreciating it for 5 years. Okay, but your years are going to start April 1st. So that's a partial. those are the important things you have to know. What I'm going to show you next, it'll be a little quick, because you're only going to look at this a little bit. You're only going to do a little bit of this, just to know what it's like, but nothing you're going to see frequently. Declining balance is basically an accelerated depreciation method. We basically take the straight line rate that we just did. So 5 years, the straight line rate is 20% per year for 5 years, right? We would double it. So instead of 20% per year for 5 years, we would do 40% until it's all gone. Okay. So that's basically what you see here. Another difference with declining balance is it actually starts with the book value. It doesn't start with depreciable cost. It starts with the actual book value of the car. Again, you are, of the truck, sorry. You are doubling the rate you saw in the straight line. So straight line was 20% per year. For double declining balance, it's 40% per year until it's done. It's done. You still can only write off a full $12,000, and your book value can only be as low as $1,000 when you're all done. So it's not like you're writing off more than 12,000. You're still writing off 12,000 in depreciation expense. You're just doing it at a faster clip. That's it. That's all this allows. So in the first year here, 40% of the book value of this truck is $5,200. You're already writing that off in the very first year. So your book value has dropped. There should be 7,800. Your book value has dropped quite a bit. That's your beginning balance for the next year, times 40% of that. You're writing off another 3,120 in your second year. Look at that. After 2 years, you've already written off over $8,300 of this truck. Okay. And then, of course, the number gets small. In the very last year, you can only write off the difference between where you're at in accumulated depreciation and where you said you would be at your maximum. You can't write off more than you said you would. And that's basically double declining. Okay, balance. And it's partial year. Okay. Units of activity, again, they use, in this case, we have $12,000 of depreciation, but we're dividing that over 100,000 miles. So for every mile this truck is driven, 12 cents a mile is going to be the depreciation. In your first year, you drove 15,000 miles times 12 cents a mile. That's your depreciation expense. Your depreciation expense will be different every year based on the miles you drove. But again, you can never depreciate more than you said you were going to, which is the most is 12,000. And you can never have a book value lower than the salvage value you said you were going to have. Okay. So this is going to be, and of course the choice, it doesn't, most managers use straight line. You see it's over 80%. Because it's very easy to do, and it's also in line with how they would do their taxes. If there's a company that, say, prides itself on the most recent technology, say I went to a lab who has the most up-to-date technology and can see basically right through my body and get diagnoses that quick because of the technology, I'm probably not going to be keeping that technology very long. Probably a couple of years before the next generation of that technology comes available. And since I'm going to be a cutting edge lab, I'm going to want that. So that means I might use declining balance because I want to depreciate this asset quickly. So if that's the case, I might be curious to use declining balance. And units, just not, both of these are not very popular, but they can be used, perfectly legal within GAAP. Okay. So again, the IRS for taxes require straight line. If you don't use the straight line method, you have to use their method called makers. And you can't use makers to estimate your depreciation on your financial statements because it's not permissible under generally accepted accounting principles. So most companies use straight line. Okay. So here you have Southwest Airlines, and they also write that they use a straight line method. Okay. And how much they have 23 to 25 years for flight equipment, 5 years to 30 years for ground equipment. So they actually tell you, and they have to tell you in the notes. Tell you in the notes. One other thing that I wanted to bring up here is impairments. This happens when there's a permanent decline in the value of the asset. So, for example, I know Robinhood's been in the news, so I will go with one of their very popular stocks called Aurora Cannabis. It's a Canadian medical and recreational cannabis company. So during a time a few years ago when this field was looking really hot uh, or lit, um, they went on a buying spree. They went ahead and they bought a lot of big greenhouse type of warehouses and things like that, and they paid a good amount of money for them. But then again, a year or two later, things didn't work out. They bought them so they wanted to grow more, but they just didn't. It just didn't happen, and so they ended up needing to write down the value of the asset on their books because they showed it at a very, very high price that they paid for it, and that wasn't actually what it was really worth. So they had to write down the asset, and that's what an impairment is. Okay, and so this is a little bit of a do it exercise for you as well. And the last thing I want to do around property, plant, and equipment is objective 3, because these are all related, and there's just a little bit to do here. And that's basically what happens when they dispose of an asset. So they've used that truck for 4 years, right? Then they're going to dispose of it. How do they do that? Well, usually it's one of a few ways. One is they actually sell it to another party. Another is they simply discard it. They scrap it. That goes to the junkyard. Another thing that they do is they might exchange the older equipment for newer equipment. Okay. And either way, that's how they usually dispose of assets. So when they dispose of an asset, they don't own it anymore. They got to take it off their books. So a couple things they got to do. First, they have to make sure the depreciation on that asset is up to date, up to the day they've disposed of it. Then what they do is they eliminate the asset from the books. How they do that is they reverse out their accumulated depreciation to zero, and they reverse out the equipment account to zero for that particular asset, not for all equipment, just the one that they disposed of. So this is what this tells us about. The most important thing to know is that book value. Okay, that's why I emphasized it so much, and I went through those charts step by step. The book value is going to be your key piece of information when you dispose of an asset. If you sell it, right, then you're going to get some proceeds, right? The proceeds of the sale, the cash you get from selling it. You have to compare the proceeds to the book value, okay? When you compare the proceeds to the book value and the proceeds are bigger than the book value, you need to record a gain on the disposal of the asset. But if you look at the proceeds and they're smaller than the book value of the asset, then you have to report a loss on that disposal. And that's relatively easy to do, but it's important to know. So let's do how it works. Here is a company that has office furniture that they sold in July. They sold it for $16,000. They've had it since January the 1st, and it has accumulated depreciation of $41,000 already. They have to record depreciation for the first 6 months of the year. The office furniture originally cost them $60,000. Okay, I don't know what the hell this is. That doesn't make any sense. I think it's the depreciation that they've had this year. So, and there's a few errors on the slide here. There's an F here, there's iCash here, there's a few errors here. So they want you to first prepare the journal entry to record the depreciation up to the date of the sale, which they give you as 8,000 apparently, because the depreciation expense is 8,000, accumulated depreciation 8,000. Okay. Now remember, there's already 41,000 in accumulated depreciation. You're adding to that here. The furniture cost 60,000. You sold it for 16,000. All these are important numbers. So what you do is you need to find out whether you made money or not. So how do you do that? You take the cost of the furniture, subtract out the accumulated depreciation to find its book value, right? So the book value is the cost minus the accumulated depreciation. Remember, accumulated depreciation was adjusted by 8,000, so it's 49,000. So that means you have a book value of this furniture of 11,000. Compare that with the proceeds. Well, you just grabbed $16,000 in cash. That's bigger by $5,000 than your book value. So you're going to have to report a gain on the disposal of this. And so how do they actually do that on the books? Well, they will debit their cash account for the $16,000, which is the proceeds they've got. They need to reverse out the depreciation. So they do that with a debit to the accumulated depreciation account. They have to reverse out the office furniture. They do that with a credit to the equipment account. And the $5,000 is reported as a gain on the credit side because it's going to go this. Any gains and losses are going to go on the income statement. You might remember back on chapter 5, we did the multi-step income statement, and underneath the income from operations, there was that other category, other revenues or gains, other expenses or losses. That's where that $5,000 is going here. It's going to go on the income statement as an other revenue or gain. It's going to be gain. Okay. So that's important. What if they sold it for 9,000 instead of 16,000? Well, again, they're still going to determine what their book value is, which you know is 11,000, right? But now they're going to compare that to the proceeds, and the proceeds are smaller than the book value by $2,000. So they are going to show a loss on the sale or disposal of this plant asset. And the journal entry here is actually incorrect because this is supposed to be on the debit column. So the loss will show up on the debit side here. Of course, they did receive 9,000 in cash. They're going to reverse out their accumulated depreciation. They're going to show the loss, which is going to be a debit on the debit side. And they're going to reverse out the equipment account to show it's done. Okay. In the case where you simply are just junking it, no cash is received, then you're going to take a loss on whatever the book value is. Okay. You're going to zero out the accumulated depreciation account. You're going to zero out your equipment account, and the rest is going to be a loss. Okay. So how would it work? Well, in this case, we have this is your do it exercise number 3 here. You have a truck that costs 30 grand. You have accumulated depreciation of 16 grand. So the first thing you need to do is what happens if you sell the truck for 17,000? Well, again, that's your proceeds. What's the book value? The book value is the difference between the two. So you need to know that information, right? Once you do, you know you got a gain, right? Because $17,000 in cash compared to a $14,000 book value, you got a $3,000 gain. So how would it look on your books? You would collect the 17,000 in cash. You'd reverse out the accumulated depreciation. You'd reverse out the asset for equipment, and then you would show the gain of 3,000. But what if in number two, your truck is worthless and you simply dump it, you retire it? Well, in that case, you are basically going to, there's still a $14,000 book value that has to be dealt with. And it's dealt with here when you simply junk it. It's as a total loss. As a total loss. Okay. That was a lot. How'd you do? I'm actually going to stop here today because I just realized after going through all that, that's a lot.